Hi, I'm Josh Cadillac, and welcome to my podcast, Know Your Shit. I've been blessed to see great success, as well as seeing the bottom up close and personal in 2008. And if there's one lesson I've learned is that if you want to have success and differentiate yourself from everyone else out there, you need to know your shit. As a successful real estate and crypto investor and an educator, it drives me insane that people do not immerse themselves in their craft. Everyone is so busy advertising and testing new sales techniques, they forget the most important thing, the product. Here I want to talk to the folks that got this right, the most successful people in the world in every industry. Bring them to you and find out what they learned in their business that made it great. When you listen to my podcast, you will know for sure that the topics and experts we have on have one thing in common. They know their shit. Hello, everybody, and welcome to Know Your Shit podcast, where our knowledge and pride in what we do drives us to be excellent. My name is Josh Cadillac, and I'll be in the driver's seat for today's show as we strive to learn how to stop doing deals and start closing for life. We have a great show for you today, and really what we have for you is a great guest. Brock, hello, Brock Vandenberg. He's here with us. I hope I didn't butcher that too badly, sir. And Brock, thanks for coming on.
Yeah. Well, hey, Josh, I really appreciate you having me on. I'm excited about what we're going to talk about today. There's just so much activity, opportunity in the marketplace right now. Things are so dynamic. And every time I say that, they get more dynamic.
Yep.
I don't know what's going to come next quarter, but I know it's going to be more dynamic than what we got today.
Absolutely. No, the opportunities are everywhere. It's a matter of figuring out where they are and reacting to it. So, Brock, before we launch into what I'm sure could be a very easy conversation, why don't you tell everybody what it is you do?
Yeah. So what I do, Josh, is I run a real estate finance company. We specialize in providing short-term financing to real estate investors. So these are people that, if you ever watch that show, Flip This House or something like that, those type of investors use short-term financing to buy houses and renovate them. So what my company does is provide that financing. And then we raise capital from individual investors that pool their capital together and lend that money out.
Gotcha. And so when you talk about short-term, are you talking about a year or less or more, or what's your typical term?
Yeah, so typical loan term is about 12 months, but in reality, people are flipping houses usually about the 6-month mark it takes somebody to buy the house, renovate it, and then resell it. But obviously, it depends on how much renovations the property needs. The big thing you're probably hearing about, we could talk about it, are accessory dwelling units. We're here in Southern California. We have a huge lack of supply of housing. It's a huge problem here in Southern California. So you see a lot of people that are converting older single-family residential homes into these multi-unit properties, ADUs, and that's a big part of our business now.
Yeah, no, I mean, it's a thing. And I mean, I'm in another market, Florida, where there's a tremendous lack of housing. And
yep.
What drives me nuts is, as a builder, I get from the state an energy efficiency guideline all the time, every year.
Okay.
And every single time it makes the house more energy efficient.
Yeah.
Simultaneously, guess what else it makes it?
Cost.
More expensive to build.
Mm-hmm.
And what's crazy is the same politicians that are screaming that we need more affordable housing are the same ones that are ramming that down our throat and not letting us build less expensively. I know it's not as efficient, but at some point, you have to weigh the human cost. And to me, the lack of home ownership is just the ancillary downsides to that, the ancillary negatives to individuals, to real human lives, and the inability to store up and build wealth is so costly. And they don't take that into account. It's like, hey, what's the problem right here in front of my face? And let's not look at, what the fallout is. And that's important.
Yeah, Josh, you bring up a great point. I mean, the same thing you have here in the San Diego market. But when you start to talk about where they only allow a certain amount of housing to be built, or have to make a certain amount of housing has to be low-income housing. So you're essentially taking the supply of market rate housing off the market to supply a low-income housing, which I think at the end of the day, it's solve it by simply just building more housing in general.
Look, I mean, every attempt there's been at outside interference with the rental market has always created shortages. It's just always been the net result. I mean, I remember reading something, I believe it was Basic Economics. Yep. And in the book, he says, every attempt at rent control has wound up with condo conversions, more parking lots.
I remember those days. Yeah.
Oh, absolutely. More parking lots and more housing for the rich or slums. That's it. Because if you now tell me, hey, look, you can't rent for more than this, what reason do I have to maintain my property?
Yeah.
You know?
No, it's a big problem.
It really is. And there hasn't been, I mean, there's been some solutions that I think were, more market driven ish solutions. I mean, down here in Florida, if you were to take when we had this big spike in rents that we had down in 2021, 2022, everybody's screaming about it, rent control, rent control. And what they did, and I think this is probably splitting the baby as best you possibly could, was they said, hey, look, if you're going to take the rents up more than 15%, rather than 30 days notice, you got to give the tenants 60 days notice. So they have an opportunity to not get caught short and go make alternative arrangements.
Makes sense.
So okay, it is a burden to the landlord, but at the same time, it's understanding human beings, and that it's also not putting your thumb on the scale of the market and causing an imbalance. And so, I mean, I thought it was a pretty good solution, but you see so many bad solutions, and I'm not saying that's the perfect solution, but you have to figure out, because this is what people think of, and this always seems to be the case. They think of the landlord as this, super wealthy, cigar smoking, overweight business person, when in reality, it's grandma, and grandma's the one, or her pension plan is the one that owns that property.
Yeah. And
so all of a sudden, when you change the face that's on that landlord, it means that you start to have to count the human cost both ways, as opposed to it tend to.
And you look at that, I think there's this idea, and I think the media kind of portrays, you're right, that these big institutional real estate owners are coming in and pushing people out of communities, raising rents, taking over all the housing. And in fact, they really own a small percentage of the actual housing that's on the market. And a lot of it, and I'm sorry, and I'm just going to apologize as a Californian for all my Californians leaving for Florida. For you.
Well, that was kind of the elephant in the room we weren't talking about. I mean,
but
north of 100,000.
But so what people don't realize is that, I mean, this is for a high cost market for like San Diego, and not just housing. I mean, just generally gas prices, prices at the grocery store. People need this income by renting out a room or two in their house, right? And to offset their living costs. It's a real big problem. And these rules that are put in place make it much more difficult for people to do that now. And that's unfortunate.
Yeah, no, it seems that the rules are designed to get people to not look to the market for their solutions anymore. They want them to kind of come to government for those solutions.
Yep.
And unfortunately, that puts people in a position where they're no longer in the driver's seat. They have to go to the passenger seat and kind of come with their hat in their hand and, please may I have some more. And that's always what I encourage my agents or anyone that I talk to stay away from that position where, you have to go begging somebody else for something. You leave yourself in a position where you have opportunities. But all right, we could keep going.
We can go, but I will always like to, with this creates opportunity though. And that's kind of what I like to talk about in terms of, in the opportunity in the private debt space, which you're involved with as well. You see it. But, being that there is a lack of housing, lack of supply of housing, there's always demand for this kind of capital, this private real estate debt. And what has happened in the banking industry over the last couple of months with a lot of these local and regional banks having issues has created a huge opportunity for people to invest in the private real estate debt market, if it's on non-performing or performing debt.
Sure. And I mean, that makes sense. I mean, because of the demand for housing, there's going to be a demand for people to come in and renovate that. And those folks have a demand for capital. And I mean, it's amazing how cyclical and all tied together that whole thing is as it moves in a unit. But Brock, let me ask you this. What got you started doing what you do, bud?
So yeah, good question. I was up in the Bay Area. I was working in the technology industry. I had read a book, and I know everybody has read this book, but the Rich Dad, Poor Dad book. And it really got me kind of just thinking about two things. Number one, investing in real estate. And then number two, kind of working for myself. And so I subsequently, this was about 2001, moved back down from the Bay Area to San Diego, started up with a private equity fund. And I sat behind a computer for 4 years doing cash flow analysis on real estate development opportunities. So when I was there, what we would do would be what's called second position debt or mezzanine debt. So essentially imagine gap lending, but at the institutional level. So these are multi-million, tens of millions of dollars development project where we come in with a slug of debt after the construction lender. And it was a great opportunity. I was growing the ranks, and I'll tell you what, it was all good until about 2007, because all we focused on was residential development projects. And so I'll tell you what, man, it was scary. I had a child on the way. But, and when they said, hey, we're shutting down the whole division, I had, nowhere to go. So, but it did create opportunity for me. At first, I had an opportunity to work for the FDIC. And FDIC has been in the news recently with the recent shutdown of some of the banks, like Silicon Valley Bank and a couple other banks. Well, that was me in 2009 during the banking crisis back then. So I would go out to the banks on a Friday evening. My team would go in, we would shut a failing bank down, spend the entire weekend underwriting their debt portfolio. And then Monday morning, opening the bank. Usually there was an assuming bank, another bank. We brought another bank in to essentially take over the deposits of the old bank's customers. But then we would take that bad debt out. And you're probably super interested about this. Package it up and then sell it off to the open market. Yep. And it was a fascinating time. Did it for about 2 years, was on the road 24/7. I probably was part of 30 plus banks that we closed, and then selling off that debt.
Absolutely. All of which, by the way, made JP Morgan Chase much more wealthy, it seems. JP Morgan always is sitting there with their hand out ready for whenever.
Yep.
Whatever's, man, it's like amazing every time.
But I call it, I call it the white collar prison for bankers. And not that we all went to prison or anything, but the FDIC needed to bring in all these bankers that put all of these loans together. And so they needed to unwind all this stuff. And I had a front row seat to some of the worst underwritten debt I had ever seen. I mean, stuff that there was no way that these loans should never been written. But, it was kind of the jumping off point for what I do now, which is to run a private real estate debt market. I saw what went wrong, applied a lot of those concepts and ideas, and applying what I do today, which is to lend money out to real estate investors to do what they need to invest in real estate. So
it's something I love. I love it.
Interesting cycle.
That's it. Is. My father used to tell me all the time, know what comes before and what comes after what you do. It makes you much better at what you do.
Oh, that's I like that. I like
right?
That.
So, I mean, that FDIC time and experience perfectly set you up to take and do this business better than your competitors, because your breadth of knowledge is just broader than theirs, that exposure. And it's such a cool thing.
I don't know if the man upstairs was looking down at me and just said, hey, this is going to be your path, but things just kind of fell into place, and I got lucky, and I got involved with some, one of the things I talk to, especially with my young sales guys, is find a mentor in the industry, someone that's successful, that's doing something in the business that you want to do. And I just lucked out and found a couple of mentors that also guided me through this, I call my real estate evolution. And so that's where we are today.
I am a big believer in the man upstairs, definitely running you through the broken road to get you where he needs you. And so our perspective is just not broad enough to see, like, why the heck did this have to happen? 3 years later, oh, I get it now. I'm so glad that happened. Yeah, no, it's a thing. So where do you think all the success came from for you, Brock?
It's one of those things. I'll tell you, I'm definitely not the smartest guy in the room. It's perseverance. I mean, I've seen ups, I've seen downs. My business is based on one hand, you're always having to find new loans to fund. And on the other hand, you're always raising money to build that loan portfolio. And so it's never balanced. Either you're looking for loans to fund or you're looking for investor capital. But you know what? Life doesn't make it easy. So you're always having to go one way or the other. So it's perseverance. What's that hour rule? What do they say? The number of hours you have to work to really specialize in what you do.
Oh yeah, I don't remember what.
Like 10 years of your life just just dedicated to what it is, and it's just perseverance. And obviously you got to love what you do too, Josh. I mean, you got to be in there every day, waking up, wanting to know, hey, something new going to happen today. I want to see what happens today and what I'm going to learn.
Yeah. What new has come my way. It's a good way to go after it, man. I mean, liking what you do, loving what you do makes it so much easier to take and do that, I think. And I couldn't agree more.
And the dynamic, again, I go back to like how dynamic. I've never seen more opportunity in the real estate market today, but then, if I were to compare it, maybe kind of in that the 2008-9 downturn, housing downturn, was maybe kind of similar type of opportunity. But there's so many more dynamics right now, or dynamics that are going in the market that's just open for anything, for anybody that's investing in any segment of the real estate market.
Well, it seems to me like this is going to be the downturn in the market will be led by commercial this time. I don't really think that residential, because of the tremendous scarcity we have on the residential side, I don't know that there's, I can't see a path to an oversupply. Yep. And without an oversupply, I don't see how pricing comes down. But with commercial, even with the most recent unemployment numbers that came out, and that, hey, we had so many jobs created. Yep. Yeah, but so many more people got fired that we actually increased our unemployment rate, which isn't a bad thing, actually. I mean, when you're at 3.4, there's a whole lot of people working that really don't want to be working.
And there's that's near zero unemployment when you're at 3%. And
I think it's actually below. I remember reading with economists, it was like 4 or 5%. When you get down to that number, like there's like 4 or 5% of the population that just doesn't want to work.
Just won't do it.
If they're working, like they're on unemployment and they're okay with that. But if they're working, then something is really wrong, right? And so I think you're seeing that. I think
that is wrong right there.
Well, sadly, but sadly true. But it's funky because, you see that number and you watch it and you realize what the consequences of that has been. And I think you've seen a lot of turnover in the labor market as people are letting a lot of people go, trying to find good employees, because much like housing, there's a scarce amount of people that are willing to really work hard. And how many you have to go through to find one of those in a market that's so undersupplied with labor. And what
I also find interesting is now, obviously, with what we're out of COVID, we're out of the lockdowns, but how that has permanently changed where people are working. I mean, you are now having home office. I mean, you talk about home offices, but you truly are officing at your house now.
Yep.
I think that obviously is one of the biggest drivers of why, especially people are leaving high-priced markets like San Diego, LA, especially San Francisco for other reasons as well. But yeah, and it's, you're seeing this in other more, what you would say, not rural cities, but where cities you didn't see as much of inflow of people coming in.
Slightly less urban cities, maybe is what we call it. It's interesting because I think that's also had an effect on the type of housing that people want and how much space they're allocating to their housing. They're making that office space no longer a little, a place to put a desk off of their living room. It's now a room in and of itself, because they realize they're going to be spending, time there. They're going to need a printer there. They're going to need a scanner there. It's not just some place to hang, stick their laptop and work from the counter in the kitchen. So,
and then also technology, how that's changed the workforce. And now you don't have to have a career with one company. I mean, you can be a consultant that provides a very narrow type of knowledge base or function for numerous companies.
Yep. It really has, the world has changed. And I think COVID just kind of accelerated what we were going to see over the next 10 years happen in a year or two. So I think that all makes sense. So
what do you think happens, though, to some of these major cities, cities like New York, Chicago, that are kind of dealing with an outflow of people? Does this change, or do we have, do you have ghost cities?
I heard about 6-8 months ago that the vacancy rate in downtown Manhattan, the financial district, was running around 75%.
Wow. For office.
And Brock, I think that you're going to take and see a major economic consequence of that, because the entire tax structure of New York City's taxation is based upon those buildings north of 90% occupied. And so I think that a lot of, I know I would have, as a business owner, sitting here saying, well, why the hell do we need this? Like, why do we need this geographical location? Why do we need the aggravation, the tax structure, all these things that are kind of set against our business, if you will, that cost us, when we can go other places that have a more friendly, more welcoming environment to us? And, you can only take and bang people over the head so much before they, they moved, but it was happening slowly. So it really wasn't that big a deal. But with COVID now, everybody has to leave their office space, and you look at how much you're paying.
Big wave.
And yeah, and I mean, you look at what that cost per square foot is, and now wait a second, every dollar we don't spend on office space goes directly to the bottom line.
Mm-hmm.
Wow, maybe we could figure out a less expensive way to do this, because that is a big expense. And so I think that for those big cities, New York, Chicago, the San Franciscos, they may have to suck it up and actually start treating business people like they want them there.
Yeah.
Which would be a welcome change. I was in New York. My family was in New York for decades.
Okay.
We had to get out. We couldn't deal with it anymore. I mean, I remember the one eviction. It was like 2 years to get somebody out of a property.
You're having those. I mean, you look at the rule in LA where you've got the mansion tax. So, you're now charged a 5% tax on sales above $5 million.
Uh-huh.
So,
just
stuff
because.
like that is, it's their way of trying to keep high net worth individuals from moving out of the city, obviously, and to increase tax revenue. So, stuff like that, it's a very anti, high tax earner way of trying to keep people in the city.
It's punitive. I mean, there's really no way to look at it other than it's punitive. And, that's, you say what you want to do about it. I mean, it doesn't really matter. But I mean, there's a rule of economics I read a long time ago. You tax what you want less of, and you subsidize what you want more of.
That's a good point. Yeah.
And so, I mean, people will always move to where the incentive is.
Mm-hmm.
And so when the price of gasoline goes up, people buy more electric cars. I mean, it's not, nobody had to take and put a gun to anybody's head. Like, people move to where the incentives are. If there's a corn shortage in Iowa, the price of sugar goes up, which means a quart of ice cream costs more and people buy less ice cream. I mean, it's just, nobody had to take and tell them the price. It's one of the most interesting things I ever read was the power of what a price does.
Yeah.
A price just communicates all this knowledge across an entire economic, system that brings this good to market. And people make the economic choice all the time based upon the scarce resource of money, what they're going to do.
Mm-hmm.
So I
was going to say, where do you see some of the bigger opportunities in real estate right now? For me, it's, these, from a lending perspective, it's accessory dwelling units. People are converting houses into multifamily units. We're not allowed to call them apartments. We can go into why that is, but they're just putting little granny flats on their houses. I mean, that's a big thing in Southern California. Where do you see the opportunity in Florida?
To me, with Florida, it's if you can figure out a way to bring single family home to market,
mm-hmm.
You're in a good place. I mean,
I see a lot of this for rent. So, build for rent type development projects.
Tons of it. I mean, for me, that's where if I was going to pick the product that I can, the ready to go product, that's not a development deal, it's picking up this older duplex, triplex, fourplex, because when you go over 4 units, the cap rates fall precipitously. I mean,
interesting.
Yeah, no, like in my state, 5. If you can find anything at 5% rate of return, you're crushing it. Now, I mean, I know in California, I used to see 3% rates of return and people were happy with that. In my market, I mean, it used to be 7.
Mm-hmm.
Since COVID, it's 5 and below. So, I mean, like if you can find 5, you're doing
So you
great.
could go buy treasuries or buy a bank CD earning 5%, even greater than 5% now.
But see, here's the wild card in that, Brock.
Mm-hmm.
That CD is going to give me a guaranteed rate of return with 0 appreciation, 0 rent growth.
Yep.
And so this is the thing, actually, I have a class on inflation that I teach this on. I take a 5 cap that I buy on $1.5 million. And I say, all right, guys, do you know what the average rate of appreciation for real estate was in the last inflationary market? The average rate per year is not the 3 or 3.5% we've been booking for the last 40. 1972 to 1982, average real estate appreciation was 9% per year.
Wow.
Total aggregate real estate appreciation from 1970 to 1980 was 177.6%. Total aggregate inflation.
And that was during you're talking about during high interest rate period.
Oh, yeah, no. In 1970, it was 7.6%.
Yep.
Average home price in the U.S. was $17,000. By 1980, Interest rate was 16.63%. Median home price, $47,002. Total aggregate appreciation, 177.6. Normal real estate appreciation in a normal decade for us has between 50 and 60%.
Wow.
This 177.6 is far and away on outperformance of the normal market. Why did it happen? Because the value of money was going down simultaneously.
Yeah.
And when the flight to quality is not, what was the flight? Bonds was the flight to quality. The real flight to quality is tangible assets.
Yeah.
Because tangible assets, their value is, they're a competitor to the dollar, right? I can have my money here or I can have my money there. What do I think's the better bet? Well, in a market like this, where we know the value of money is falling and the price of everything is going up, is real estate part of everything? As it turns out, it is. And if my eggs cost me more to buy, and my car cost me more to buy, and the table cost me more to buy, what makes anybody think shelter is going to be the one outlier that now is going to become less expensive?
Yeah.
It's our money has fundamentally changed in value in a way we have not seen in 50 years. We haven't seen inflation north of 3% in more than 50 years. So this is going to mean that the way it's going to look, it's like, oh, these prices are crazy. My father's 1974 macked out, top of the line, Fleetwood Brom, 20+ foot long Cadillac was $7,000. That car now is over $100,000. I mean, money just, look, here's the ultimate. Gold, an ounce of gold in 1972 was $35.
Okay.
It's $2,000 and more today for that same ounce of gold. That's what's happened to your money in that period of time.
Do you think the money, the value of money will continue to drop in value? Because that's, at the end of the day, that's what's happening, precipitous at that same rate.
I don't know, Brock. The caveat for this whole thing is that I look at the inflation of the 1970s and the Fed raising rates, and you see the spike up and you start to see it come down, and then it spiked back up again. And so in like 77, it had reached a low and spiked back up in 78 and 79, maybe it was 76 and 77, 78, 79. It spiked back up. So the stickiness of inflation is something that people don't realize. And the tight labor market, we finally saw numbers with this last, even though the new jobs number was much higher, but we had the number of people that got laid off increase significantly. That's the first labor numbers we've seen that in any way takes and shows us any let up in this overly tight labor market. As long as labor stays tight, wages have to go up, because everybody's going to be knocking on the boss's door and saying,
I need a raise.
I need a raise. And what's the boss going to do? Well, I got those 3 guys that are waiting to be interviewed. All 3 of them don't even have their shoes tied because they can't figure out how to do it. And they're not wearing matching socks, for God's sake. They're like, I got to keep the people I got. And so as long as that's the case, I mean, that has been always the ultimate indicator of whether or not we're in a real estate bubble. If wages are going up, real estate prices have to go up. We've had 3 very strong years in a row for wages. Sadly, we've also had 3 very strong years for inflation, which means the value of money's been going down faster while wages have been going up faster. The difference between the two has been wider in the last 3 years than it's been in the last 50, which means people's standard of living is actually falling faster than it has in the last 50, but your paycheck's bigger, so enjoy that. Either way, you qualify for a bigger mortgage because the total number of dollars you're earning is higher, which means real estate prices are going to go up.
Continually go up, yeah.
Well, until the labor market loosens, and then people don't have the money. But I mean, I think you're already seeing discretionary spending start to fall. But once again, especially after COVID, I think COVID drove the idea home of just how important where you're going to live is, because you get stuck there, right? And so you don't want to live someplace you hate or is too small. And so
so that brings up the next question here, and I get this question all the time from my investors is, number one, you have if you're here in San Diego, in the county of San Diego right now, we have over 2.5 million people in the county of San Diego. Right? We have 1,900 listings. That's it. Right? This time about maybe 2 years ago, you had roughly 55 to 6,000 listings.
Yep.
Right? So when you talk about there's just nothing available. But one of the reasons is why would you want to move? You've got a 2.5%, 3% mortgage. You really want to move and find a 6 or 6.5% mortgage?
Absolutely. Or worse. Look,
What breaks that?
Here's the thing. At some point, rates will come down because I don't think the economy is going to be able to sustain.
Mm-hmm.
I think the Fed may have to suck it up and let there be some more inflation, because I think that the cost of this rapid tightening, in addition to the banks that they caused to collapse.
Yep.
I mean, what did these banks do wrong? They were holding U.S. Treasuries.
Yeah.
That's what their big crime.
That is the irony, isn't it?
The irony is the federal, and I love how the Fed is like pointing their finger. Oh, the poor investment strategy. They were holding your paper, for God's sake. You know, it's just that they were holding long-term paper because they were expecting you to have some sort of consistent financial policy. Yeah, no, it gets me grumpy all the time when I think about it. It is what it is. But I think as you look at this, right, there's really only three sources that inventory can come from, right? Only three sources of supply that we can get to. We got end users. What's going to make the end users, as you said, walk away from these really low interest rate mortgages to do one of three things? They got to go jump off a bridge, move to Tibet, or become renters. Because if they do anything but one of those three things, it's a net zero to my market anyway. Yeah. So if they sell and rebuy, we're still at 1,900 listings, right? Doesn't help. So what's going to make that happen? I don't see anything that's going to make that happen, Brock. And I don't think they can ever get interest rates down as ridiculously low as they were, because that's for time of crisis only, right? At that level. So these folks are going to have to be incentivized by prices getting high enough and then having some sort of alternative. And I don't see that coming. I mean,
or you're going to have some big shift in employment market that forces somebody to move.
Correct. And so like all this talk of AI coming and taking everybody's job and all, as we literally watch the labor market so tight that it's bleeding, right?
Yeah.
And so, I mean, will there be this massive shift in employment? I don't think so.
No.
You know, I don't see it. Maybe 5 years down the road, you know, it starts to make a dent. But I don't see it right now. And so I think that you're stuck looking to one of the other two sources. And I think that the place where the supply is going to come from, in my mind, is going to be the developer side. I think that prices are going to get high enough eventually, despite the government's effort to continue to price developers out of their ability to develop. I think at some point the incentive is going to get there. The price are going to get high enough that I call it the little red dress.
So you're going to start to see more development opportunities.
You're going to see development,
more supply coming into the market in some of these markets.
Absolutely. I mean, I could tell you as a developer right now, I am slow rolling everything.
Okay.
The providing of single family home product, absolutely slow rolling, because interest rates are up. Guess what? I don't build out of cash. Almost no developer does. They borrow the money to do, which means that makes it more expensive. Labor's more expensive. It's hard enough to get workers. And then when you get them to show up and be sober, right? That would be a nice change of pace. So you got that problem. Materials are still more expensive than they were, right? And so that's a double whammy. And then the other one that nobody really talks about anymore, but is still a huge issue on my end, is the supply chain is still screwed. It's still not consistent.
I still see it.
Absolutely. I tell the story all the time. I had a kitchen we went to order a few weeks ago. And when I called up, so 1 week lead time in the kitchen, got the check from the customer. It was just a kitchen renovation we're doing for somebody. Got the check, placed the order the next day, 12-week lead time. If I'm building that house, I just signed up for 3 months of debt service. Plus, what did that do to my cash flow? I need that cash flow from that sale in order to fund my debt service, in order to take and maintain my loan, in order to take and fund the next one that I'm need to be closing out on, to take and keep this whole thing going. We don't make any money as developers until the last 6 or 7 homes that we sell. And so if that cash flow now is a riskier cash flow metric that I'm looking at, model, well, I have to price that into the price of the house. I have to charge more profit, because the likelihood of me making that higher profit number is significantly reduced because of the additional risks that I'm facing. And so if they were building at the numbers they were before, that number has to be not whatever the difference in aggravation. It does have to be that plus a risk modifier on top of that. And everything that we've seen has done nothing but add risk to the model of being a builder.
Okay.
Plus throw into that the aggravation with permitting now. Everywhere I go, anywhere around the country, they have used COVID as the excuse to just take and slow roll their jobs. I mean, I have places that 6-8 months to get permit approvals. And I mean, what the hell do you do then? You're sitting there on this property. You're sitting there with, financing ready to go. Brutal.
Well, look, we've been dealing with that in California for a long, long time. Again, and it all goes back to, why is the cost of housing so expensive? It's important you know who's sitting in your county seat and having a voice for this. And
the thing,
telling people that, look, I'm sick of having, not having a house to buy, or being able to move up, from a smaller house to a bigger house, because there isn't any house to buy. So,
is it right?
I believe that's what I do believe, that people will move. It's not as sticky as people think, having a low interest rate. I think, like, if you have a growing family and you're in a condo right now and you want to buy a house, look, you know what? Yes, it's unfortunate that you're going to have to sell that, may have to sell that condo, which, by the way, most people won't. They're going to rent that. They're going to hold on to it and go out and buy their next property if they can. But they're going to sell that condo and they're going to go buy another house. And you know what? They're going to pay a little extra. But because the employment market is so strong, they are making more money, and they can offset that higher cost of housing with the additional income that they're making.
I agree. I agree that, Americans are very bad at holding out and under consuming for any length of time. There's just too many shiny things out there. The one thing that kind of terrifies me about what you just said, and I don't know if I'm right to be terrified or not, is whatever solutions the politicians come up with to fix the problem. They're going to take and fix the housing. Last time they fixed the housing,
force you to sell the house.
Yeah. Let me get out, guys. Let me get out. And pick up the pieces afterwards.
Well, there is legislation. There has been ideas and thrown around, is that you're getting taxed more. So if you own rental units, you're going to get taxed for just owning rental units, and that's the idea of, hey, kind of pushing people out to owning rental units. Which, again,
I wonder what that does to rents.
I'm sorry?
I said, I wonder what that does to rents.
You think?
I don't know. There's a line, I forget where I heard it from, but profit is a cost of doing business. If it ceases to be profitable, no one will do it. And if politicians just could get their head around that there's not an infinite supply of money, and that we're all out here scrounging around trying to figure out how to carve out our little piece for ourselves, and now you're going to take another bigger slice of it, everybody's going to take and adapt and find some way. It's going to be a thing. So let me ask you this. What do you think makes you good at what you do?
Yeah, good question. So, obviously I've been doing it for a long, long time. I feel like I'm aging myself at this point. But, we've been in the private debt market since about 2008, and you've seen literally everything being thrown at us. We had we're coming out of the housing crisis, trying to raise money in that marketplace, looking for opportunity. And at that point, Josh, you could actually go down to the courthouse steps here in San Diego, and they'd be selling 50 to maybe 75 homes on the courthouse steps. They would be literally there, and that's unheard of in San Diego. Today they may sell one house in a given week on the courthouse steps, but they were unloading these houses. So, and then you start to see that kind of die down in 2012. And then where people were going out to really kind of what we'll call the consumers, the owners of properties, and saying, here, we're going to go ahead and buy your house. Now, San Diego works for that fix and flip market because, number one, the housing stock is aging. So you've got a large percentage of homes here that were built in the 1970s and older. So they kind of got to their end of life functionality. And so, a lot of these developers are coming in and either tearing these houses down or doing significant improvements on that. And so you saw that kind of transition from bank-owned properties from 2012 into going into the consumer market. Now it's a huge market for investors to simply go straight to consumer. So if you own a second house in San Diego or some of these urban markets, you're getting flyers every day direct from investors to buy your house direct. It's a big, big business. And so it's become institutional. We got some big banks coming in and backing some of these developers to doing this. ADUs, we talked about, accessory dwelling units, where we're financing a lot of these kinds of projects, has really changed the dynamic of what we're investing. It kind of brings us to where we are today, where we're focused a lot more on multifamily development loans that are really dedicated to developers that are buying up again, where they're doing zoning changes. We're doing a lot of urban zoning changes in kind of downtown and outside of downtown San Diego to bring more housing in. So you're seeing a lot of people buying up some older homes, tearing those down and putting multi-unit projects there. The hurdle we have on that, Josh, though, and you talked about this, is it's about a 1-year permit process. So once you buy that house and you submit that first permit, assuming that everything seems correct, it's about 12 months before you can put shovels in the ground on that. So you can imagine the cost, the holding cost it takes for somebody to go through that whole permitting process, and then hope that you don't have some type of bank crisis where you can't get a construction loan at the very end of getting your permits.
And right? That's basically the game of musical chairs. The music doesn't stop while you're without a chair. Yeah.
No, or interest rates blow through the roof, or your supply chain blows up. I mean, this is stuff I feel bad. You guys from the development standpoint have to deal with this every day. I'm just simply a lender, just giving money out. So it's tough business. So I enjoy it. I love doing it. We've funded over 400 million in loans. We currently service a little over 55 million in debt. And this is all short-term, 12, 18-month debt to real estate investors. The demand is out there with banks, really pulling back on the lending that they do, especially with the banking crisis, trying to create liquidity onto their balance sheet. We get a lot of referrals from bankers that, telling their clients that, hey, we're just not lending at with the level that we were before. And here's an alternative option that you may want to consider. So we see a lot of business, coming from that side of the business as well. So it's been a good ride. We launched our mortgage fund in 2021. We've been kind of our business cycle, our business model was to marry up individual loans with individual investors, called trusted investing. So we would, borrower would come in and say, hey, I want to borrow X amount to buy this house, rehab it, and sell it. And we had a stable of investors that we would connect on that loan. But we just grew too big. We had over 2,000 investors trying to marry them with each of these loans. And we said, look, it's a better option is to just invest in a fund, pool that money, and then that fund is what is the actual lender on the note. And because we structured it as a REIT, a real estate investment trust, there's some tax advantages that come in with the distributions that are made to investors. So again, the market's it's very dynamic. You have to adjust where the opportunity is, especially on the lending side. Where are you focused your lending? How are you doing your lending? And then how are you kind of working with your investors to ensure that, you're lowering their risk on their investment and then really making sure that they're getting the highest return they can on their investment.
Absolutely. No, that's where it's at. I mean, that's what a good lender should be doing. Absolutely. It's not just about making the loan. It's about making the loan perform and perform successfully, because that's how you get business again and again and again.
Yeah. And, it's, people think, okay, hard money lender, they're loan to own. They don't, they're the high interest rates really kind of is so different. The private lending industry really kind of it fills this gap that conventional lenders, can't fill, if it being that you have to fund quickly on a loan, or maybe the property doesn't meet the criteria of the bank. I mean, there's so many reasons why, and these borrowers have great credit, great experience, but they just don't have the time to go through conventional financing. This is why the private lending industry is a balloon, has become huge.
Sure, absolutely.
So, we're feeding the opportunity. And I like to say we're redeveloping kind of older communities that need investments to come in. We're feeding that. We're providing the capital for developers like you to come in and redevelop these areas.
Well, I think the other thing that's kind of interesting is with interest rates going up, the difference between hard money and conventional has narrowed significantly. And so where you're looking at, 4 versus 12, let's say, 8 versus 12, it's, well, gee, all right. It's not that much as much of a gap. And so it's not that big of a difference in your pricing when you're figuring.
Yeah. And the developers know, these investors know that there's a cost of doing business, but the profit on the back end of this, the opportunity on the back end of it, they understand going to pay the cost of the financing for it.
Absolutely. It's supposed to. It needs to be priced into the model. I mean, at the end of the day, the interesting thing is name one developer that hasn't gone BK at some point, right? They all wind up getting busted out at some time, because it's kind of this game of musical chairs, always trying to make sure that, your project is the one selling out as the market starts to change. And so it's a thing. Let me ask you this. What are the most important things you've learned in the process of doing what you do?
Okay. So yeah, number one, be honest and transparent in what you do. Okay. So, I've had the opportunity to be guided by some good mentors who have been very successful in the business. And so, one of the mantras we have in the office, just be transparent about the risk that you're taking, from an investment standpoint, even on the borrower side. So, I tell my salespeople, look, we underwrite dozens of deals every single week, and some of them just don't pencil. And you've got to be able to tell a borrower to say, look, we've run the numbers, we'd be more than happy to provide the financing to you, but I'll just tell you, this is not a profitable deal. And what it does, it kind of creates that foundation that people are confident in the service that you offer, right? I can't tell you how many people have told me, Brock, you were so right on that I shouldn't have done this deal. I'm glad we walked away. There's that old mantra, the best deal I did is the deal I didn't do, right? And so I always just say, look, that's been honest, transparent. I mean, that's the number one thing I think you have to look at. And number two, real estate is a long person's game. Nobody comes in here. Very few people can come into this business and be successful right off the bat. It takes years. I tell my salespeople, it takes 6 months if you're coming in brand new to get your first deal. And I don't know why 6 months, but it seems to always be 6 months is the timetable for anybody. Hey, maybe you're buying a house to flip. It's going to take you 6 months to build that network of people, to have those conversations, to feel confident in what your business is. For me, my sales guys, hey, and gals, it's going to take 6 months really to build that pipeline of loans. So it's a long person's game in real estate, and understand where you're going. This is the third thing. Understand where you're going with real estate. Okay. What is the end goal that you want to get to? And then work backwards. It's like on a real estate deal, work backwards into what you're going to buy a piece of real estate for. What's the potential profitability? What's the cost to get you there, including your hard costs, your soft costs, financing costs? And at the end of the day, that's going to tell you how much profit you're going to make based upon what your buy is. Same thing goes in general in real estate. Where do you want to go? Where do you see yourself in 10, 15, 20 years? How are you going to get there? Back into what you need to do to get there. And I think that was someone and I didn't just make that up. Someone actually told me that once. So I stole that from somebody, and they said, Brock, where do you want to go? Here are your steps going backwards. Find a mentor who's done those steps, and you'll be just fine.
This is something that I've been talking to people more and more about, because it's everything that we do any kind of coaching on. It's always that start at the end and work backwards. And, you got to do the exact same thing with life.
Yep.
At the end, what do you want that eulogy to sound like? Work backwards. How do I live my life today to be that guy that they're putting in the ground, whenever that is, right? Yeah. Work backwards. And that helps you make the decision on a daily basis that you need to make to get to where you want to get to. Brock, it seems like you're passionate about what you do, brother. What do you think makes you passionate about it?
You gotta love it. You gotta just love what you do. I live, breathe, eat real estate finance. If you went home, my wife would just, Brock, I can't deal with it anymore. I can't listen to the deal that you just funded. I can't. And I get excited. I love talking to people like, meeting you and talking to you about real estate. It's so fun to just understand what also other people's objectives are in real estate and their thought process is in real estate. It's just, and again, when I talk about being dynamic, it's dynamic around the country. Stuff in Florida is very different than stuff here in California, where it may be very different in Washington and the Midwest. So there's different ways to, I hate using the word skin a cat, but like different ways to invest in real estate. You just find one way that you enjoy doing, and hopefully it'll be profitable for you.
All right, kind of a little bit of a lightning round here to kind of wrap this up.
Okay.
What are you most proud of in business that you've accomplished?
Recently we launched this mortgage fund. So it was a big thing to launch a fund. First of all, it's a big investment up front. You're competing against some institutional capital, very smart people out there. And then you really kind of rejigger the team. You got to make sure that the team is ready to kind of take a new investment strategy. So I think that's probably one of the biggest things I'm proud of what we've been able to accomplish, over just the last 24 months.
Nice. Love it. What would you say you're most proud of in life that you've accomplished?
Well, I got a family. There was no way 18
answered
here. I had kids and they're still alive.
There we go. Despite your best efforts. Yeah.
I got lucky. I met my beautiful wife, and she's the one that kind of is the rudder in my life, and make sure that we're on the straight and narrow. But yeah, I looking at myself when I was 18, there was no way I thought I'd be where I am today with a family and also running the business.
Love it, man. What one piece of advice would you give our listeners?
One piece of advice: do it. Just go do it. Okay. And I'll tell you, there's this analysis paralysis. You can read every book, you can look at every spreadsheet, you can look at, I guarantee you're not going to know everything, and it's okay, right? Somebody next to you, Steve Jobs said this. I think he did it in a great speech, and I watch this every occasionally. He's like, look, everybody out there started from nothing. Just did it, just went out and created a company or launched an idea or did something. And no one is any smarter than you or me. Someone just went out and did it, and you can do it too. It's just a matter of you taking that first step and trusting the process, just trusting the fact that if you put enough time and effort into whatever you decide to do, you will be successful. Don't worry about the guy next to you being more successful right now. Don't worry about him. Focus on what you want to do and how you want to be successful. And I guarantee you it happens. I don't know why. It just does. You put your mind to something. Like I talk about, hey guys, we need to close whatever X dollar amount. I don't know how we're going to do it, but I know if we do these 5 things, something good is going to come from it. And it always does.
My mother used to say all the time, and it's a line that has helped many people I know. You can do anything you put your mind to.
Oh, true. Yeah.
And it's a thing. All right. Change of topic here. What one book or movie would you recommend to our listeners?
Well, I'm a Rich Dad Poor Dad guy. It launched my and I know a lot of people say that, but it did really have a huge impact on where I am today. It started it out. There's a couple other great sales books out there. Mind of a Millionaire kind of book is, talk about how people look at wealth. And understand wealth and how to build wealth, one being, owning real estate. Those things are all important books that you should read.
All right, good stuff. What is next for you? What's the next bit? You got the fund launch. What's the next project that's rolling around in the back of your brain?
So, Josh, we've raised a little over 50 million in the last 2 years for the mortgage fund. Our goal is to be at 100 million. We think there's that much demand for our capital here in the Southern California market. So that's kind of where our focus is right now, where I think where we want to be going. And then just building a great team. I've been blessed with a great, just working environment and great team that kind of shares the same passion as I do. And so just continue to build on that.
All right, cool. What do you do, Brock, to unwind?
Tennis player. I'm a big tennis player. I'm a competitive tennis player. I've had 2 kind of losses.
I was a little intimidated, even what you just said, how you're competitive. I got a little intimidated. I'm not going to lie. Competitive.
No. If the tennis court is my second home. I enjoy it out there. I'm getting old. I found that I can't compete with these younger kids. I might be having to go to some of these 40 and plus leagues, but I unwind on the tennis court. I could say the golf course, but I'm no good at it. My golf game is not great.
Yeah, I wouldn't know. I just stay away from it. I assume I'm going to suck. So why? Brock, where can folks find you? Thank you so much for this. Where can people find you if they want to find out more about what you do?
Yeah, Josh, this has been great. Thanks for the conversation. You can find me at TaliMarFinancial.com. That's T as in Tom, A-L-I, M as in Mary, A-R, TaliMarFinancial.com. And, if you're a borrower looking for private financing, please consider us. We focus on the California market. And then again, we're raising money for our mortgage fund where people can invest in a basket of performing loans.
Good stuff. Brock, thank you again, my friend. It has been a genuine pleasure talking to you. And to all of our listeners, thanks for hanging out with us. Until next time, we'll see you on the Know Your Shit podcast.
Thanks, Josh.